Did you know there are things you can do in the structuring and setup of your cannabis business that can pay huge dividends in terms of making it more efficient, less frustrating, and putting more money in your pocket in a tax efficient manner? One of those things is how you set up your new cannabis venture. So today, I'm going to give you the 5 mistakes to avoid when setting up your cannabis business. So let's get to it. Hi folks, Chip Schwager, the Greenleaf CPA, and I help cannabis entrepreneurs build and grow exceptional businesses. Welcome to Ask the Greenleaf CPA. Starting a cannabis business is exciting, but don't overlook the details. It's important to think through which type of business entity makes the most sense for your company today and down the road. As you make your decision, you'll also want to steer clear of 5 common mistakes that entrepreneurs make when selecting a business entity. And if you've already set up your company but are now having second thoughts after we run through all of this, don't worry. I'm also going to talk about a hack you can use to change how your company is taxed if you hear anything here that gives you pause. And if you're new to this channel, go ahead and hit that subscribe button and click the bell so you'll always be the first to get my tips and tricks. Okay, so let's get to the 5 mistakes to avoid. And the first mistake is actually not forming an entity. There's an old saying that not making a decision is a decision in itself. Similarly, not choosing an entity structure leads to the default of operating as a sole proprietorship. And this is the single biggest mistake I see. I consult with cannabis entrepreneurs, but occasionally mainstream business owners as well, who may have a few businesses and are looking for some help. And my most important piece of advice is you should always have an entity in place. And by that, I mean a legal entity. And here's why. Having a legal entity provides you with asset protection to ensure any future claims from creditors can only be satisfied with the assets in that legal entity. And in the cannabis industry, this is super important. Plus, there are personal benefits to having your business under a legal entity. And, oh, by the way, in a lot of states, your license needs to be held by a legal entity. Now, I'm not a lawyer, but I am a CPA, and I have seen this in tons of cases where someone just starts into a business without a legal entity. Huge mistake. The business structure you choose can significantly impact some important issues in your business's life. And these include exposure to liability and at what rate and manner you and your business are taxed. It can also impact your financing and your ability to grow the business, the number of shareholders the business has, and the general way the business is operated. Now let's pause for a minute and talk about the major types of legal structures. You'll hear a lot about an LLC and often what's called an S corporation or a corporation. Now each of these have benefits but also have requirements. For example, an LLC is generally easier to set up and to run, but has some restrictions. Now, while LLCs and S corporations are 2 terms that are often discussed side by side, they actually refer to different aspects of a business. An LLC is a type of business entity, while an S corporation is a tax classification. An S corp election lets the IRS know that your business should be taxed as a partnership. Now, to become an S corporation, your business first must register as a C corporation or as an LLC and meet specific guidelines by the IRS in order to qualify. And if you want more details on this, check out my episode where I talk about the 6 steps to setting up your new cannabis business. Right up there. Okay, all this talk about entity selection brings us to the second huge mistake that you want to avoid, and that's failing to research your options. Not researching all your options at the start could put you and your business on a path that doesn't really match your goals. For example, if you do decide to have shareholders down the road, do not make your company an LLC. LLCs are owned by partners who share the profits. Partners are more involved in the business plan and operations, whereas shareholders are simply investors. Often, shareholders have a vote, but they usually only take up 49% of the shares max. So if you're looking to add investors down the road, it's easier to do with a C corporation. Okay, the third mistake to avoid is focusing on short-term rather than long-term plans. Structuring your business for the short term and not considering the future, such as the potential for investors or new owners, can really put you in a bind later on. And this is super important if you decide that you would need to raise funds for growth in the early years of your business. If so, you're going to need an investor-friendly structure. And as we talked about, that might be a C Corp. The C Corporation also allows you to issue multiple classes of shares, which is also a requirement for investors who usually request separate share classes be issued for each investment. The fourth big mistake to avoid is only considering the tax advantages. So what do I mean? It's a huge mistake to select your filing type solely because it offers certain tax advantages. For instance, you'll see some niche organizations in their early days avoiding C Corporation status at all costs, even when it's clearly the most functional entity for their business model, growth goals, and industry. Now, these tax considerations must be balanced with liability concerns, government regulations, and ultimately, your vision for the business's future. Oh, and by the way, depending on the type of structure you settle on, you're going to have members or partners or shareholders. How one of these is taxed is the same for all of them. So if you've got a passive investor who just wants to invest in your business, you've got to consider their requirements as well. And the fifth mistake to avoid is keeping it casual with multiple owners. When forming a partnership or LLC with people you know well, you may be inclined to skip the official paperwork. After all, you're friends, right? Everything is unicorns and lollipops. But what happens when the shine wears off? What happens if you and the other owners have a falling out? And it happens all the time. And so in long-term ownership situations or in case of separation, all of this needs to be considered. The more specific their agreements and terms, the better. I tell folks, hope for the best when setting up your cannabis company, but plan for the worst. And that includes protecting you and your business in the event of a messy divorce. So there's 5 common mistakes you can avoid. I know it's a lot. The good news is that it's fairly easy to avoid these common mistakes simply by exploring all of your options, thinking about where you see your business going and growing, and in the years to come, and being sure to formalize any business relationships. Okay, before we finish up, let's pivot a bit. Let's say you set up an LLC, but now you don't want the tax liability to pass through to you, which is especially important in our industry because of Internal Revenue Code Section 280E. If you've been in this industry for any amount of time, you know about 280E. One of the most frustrating tax law sections for cannabis companies, 280E forbids businesses from deducting otherwise ordinary business expenses from gross income associated with trafficking of substances on Schedule 1 or Schedule 2 of the Controlled Substances Act. The IRS has subsequently applied 280E to even state legal cannabis businesses, since cannabis remains on Schedule 1 as a controlled substance. So if your business touches the plant in any way, you're subject to 280E. Now, most cannabis companies have high tax bills because of the negative impacts of 280E. These negative impacts are passed through to the owners of the business when they're incorporated as a partnership or as an LLC. So if your company is set up as a single member LLC or a multi-member LLC, the tax liability passes to the individual members and carries the potential for a large personal tax liability. Some companies make special distributions to cover the owner's or partner's tax liability that's passed through to them from the company. But the tax liability is still on the individuals. It's still on you. So another option is to elect to be taxed as a corporation. That way, the tax liability is paid by the company rather than being passed through to the individual members or partners. And typically, this tax election is made by filing IRS Form 8832 to change your business's tax classification. So what is Form 8832? Well, quite simply, it's a form certain businesses can use to elect or change how they're classified for federal tax purposes. All businesses receive a default tax classification, which can result in paying more business taxes than necessary. If you're eligible to use the entity classification form, you can change your tax election status and potentially lower your personal tax liability. Now, you're not changing the legal structure of your organization, but you can change how it's taxed. Form 8832 is a voluntary election form. You file it with the IRS to let them know that you want your company to be taxed as a corporation. And doing so alleviates the personal tax liability that comes with a single member LLC or a multi-member LLC. Now, not every type of business can use Form 8832 to change their business's tax classification. If you have a partnership, a single member LLC with one owner, or a multi-member LLC with two or more owners, you can use Form 8832 to elect to be taxed as a C corporation, a partnership, or a sole proprietorship. If you're currently an LLC taxed as a corporation, you can also use Form 8832 to revert back to a previous tax classification. And here's the pro tip. If you're happy with your current or default tax classification, you don't need to worry about Form 8832 at all. And keep in mind that your business can only change its tax classification once every 5 years. Also, sole proprietorships, as opposed to single member LLCs that are taxed as sole proprietorships, aren't eligible to file Form 8832 elections. Also, if your business is a corporation that wants to be taxed as an LLC, you don't file Form 8832. Instead, you need to contact your Secretary of State to find out how to legally convert your corporation. Additionally, if your business is an LLC that wants to be taxed as an S-Corp, you'll file Form 2553 instead of Form 8832. So why am I talking so much about Form 8832? Why is this important? The bottom line is Form 8832 can affect your bottom line. If you don't fill out Form 8832, your business will be given a default tax classification, and you may end up paying more business taxes than you really need to. If you choose wisely, changing your tax election status can potentially save you thousands of dollars per year. Why? Well, for one, members of LLCs and partnerships are considered self-employed individuals, and as such, they generally carry a higher tax liability than corporations. And these higher tax liabilities are usually in the form of self-employment taxes that you pay rather than the portion of the FICA taxes that a typical company would pay for their employees. Add to that, individual tax rates vary depending on your taxable income, including the income from your cannabis business. Remember that 280E thing we talked about before? Well, that only makes your personal tax liability higher. So while individual tax rates can be as high as 37%, corporations are currently taxed as a flat rate of 21%. And this creates a huge opportunity to save tax dollars. So there you have it. If you want to learn more about how to set up your cannabis company, be sure to reach out to a knowledgeable attorney or accountant. Now, not any lawyer or accountant will do. You've got to have one that's knowledgeable and experienced in the cannabis industry. Just had this the other day where a client had a lawyer involved with setting up and really asked some very basic questions that a good cannabis attorney would clearly know were dumb questions. I don't want to name them, but I will strongly suggest that you vet your service providers to make sure they know this industry. Just saying they're a lawyer or an accountant so they must know is not good enough. These folks are out there screwing it up, innocently or otherwise, all the time. If you've enjoyed today's episode, please give us a like, and if you'd like to see more, hit that subscribe button. If you do want to learn more about anything I talked about today, you can also check out my website at www.thegreenleafcpa.com. And if there is something that you're stuck on in your cannabis business, go ahead and drop a comment down below. I get back to every one of them personally. We drop new episodes each week, so I hope you'll join us again. Thanks so much.